Hello guys, this is Abraham. From my first video I introduced myself. Yes, I am just starting this channel newly. I believe we are going to work together and we are going to learn a lot. So in this video I'd like to explain some terminologies in forex and tell you what forex is. So now, this is a brief note I have for you. What is forex? Forex is simultaneous buying of one currency and the selling of another. There's nothing much to say. Currency are traded through forex brokers and are traded in pairs. Yes, currencies are quoted in relation to other currency like the Euro USD, GBP USD, USD CAD. All these are traded in pairs. Why traders trade forex? Yes, they're asking why do we trade forex? Currency traders buy currencies hoping that they will be able to sell them at a higher rate in the future. That is why they buy and sell currency. The forex market is traded 24 hours in a day and 5 days in a week, only closing down at weekend. These are few terminologies in forex. Okay, let's look at them. What is pips? Pips is the unit of measurement to express the change in value between two currencies. E.g., Euro USD moved from 1.1050 to 1.1051. That 0.0001 USD rise value is 1 pip. Okay. USD JPY moved from 1.143.11 to 143.12. That 0.01 JPY value is 1 pip. Note, the USD pairs, the pip calculation value is in the fourth decimal place. Just like this one, you have 0.0001 to 1 pip. For JPY pairs, the pip calculation value is in the second decimal place, which is, for this, you have 0.01 to 1 pip. If it were 0.02, it would be 2 pips. 0.09 would mean 9 pips. What is lot? A lot is a unit measuring a transaction amount. Orders placed in your trading platform are placed in sizes known as lots. There are different types of lot: the standard lot, which is 1, the mini lot, which is 0.1, the micro lot 0.01, and the nano lot. The minimum deposit needed for each of these lots to be used. For the standard lot, you need a minimum deposit of $100,000 and so on. Ask and bid price and spread. Bid price. This is the price the broker is willing to buy the base currency for the code currency. If you want to sell something to the broker, they will buy it from you from the bid price. Ask price. This is the price the broker is willing to sell the base currency for the code currency. When you want to buy things from the broker, he will sell it for you from the ask price. Spread. Spread is the difference between the ask price and the bid price. Now, it is the amount in negative before the market starts to move in your direction or against you. For example, the spread is 9 and the lot size you use is 3. When you do 3 times 9 is 27. So your account will start with minus $27 as starting price. Leverage. Leverage is the ability to trade a larger amount with a much smaller amount in your account when using a margin account. That is leverage for you. The broker have enough money to give you to trade, but you have to stake something in return. That is what leverage is all about. Account without margin. Just imagine an account without margin. To trade one lot, the account size needed is $100,000 for zero margin account. But for account that has at least 1% margin, to trade one standard lot, the account size needed is $1,000, unlike the other one, which is $100,000. Now, that's because they have what they have a 1 to 100 risk to reward ratio for a 1% margin. What 1 to 100 means? It means for every one box you have, 100 bucks is at your disposal. Margin. Margin is the amount of money you are required to deposit with your trading platform in order to order and maintain position in the forex market. Margin is also used as collateral to ensure you can cover any losses you might incur in the process. Margin requirement is the amount of margin required to open a position. Required margin is the money that is set aside and locked up when you open a trade. That is required margin. For example, if you open a $10,000 worth mini lot position with a required margin of 2%, which is 1 to 50 leverage. Now, 10,000 divided by 50 is going to be $200. So now $200 will be locked up during the duration of the trade, which is your stake. This $200 can be used to open other positions as long as the trade is open. Once you close the trade, the $200 margin will be released. Equity. Equity is your account balance plus the floating profit or loss of all your open position. It represents the real-time value of your account. So, if you have any open position, the floating balance you see, the changes in the balance you see is known as the equity. If no position is open, equity is equal to balance. Free margin is the money that is not locked up due to open position and can be used to open new positions. What is use margin? Use margin is the money locked up due to open position. Okay, you can read the rest. Margin call level is the specific level in percentage where if your margin level is equal or below it, you won't be able to open new position. Stop out level is the specific level where if your margin level is equal or below, your broker will automatically start closing your position. Good. Margin call occurs when you have breached the margin call level but still above the stop out level. The stop out, which happens once the stop out level has been breached, is when your open position will be automatically closed or liquidated to prevent a negative balance. This is the formula to calculate margin and leverage. Now, margin of 1%, margin is equal to 1 times 100 divided by leverage, while the formula for leverage is 1 times 100 divided by margin. For instance, you are given a leverage of 1 to 500. Now, to calculate the margin is 1 times 100 divided by 500, which is your leverage. And your result is going to be 0.2. Now your margin is 0.2 in percentage, right? So now leverage. Leverage is 1 divided by 1 times 100 divided by margin. When you are given a margin of 2%, leverage is 1 times 100 divided by 2, which is called to 50. Now for that, your leverage is 1 is to 50. Now these are the leverage and their margin percentage as seen in the box. What is short? Short simply means sell in forex. Long simply means buy. Short and resistance. Support and resistance rather. The peak of each wave in the market chart is known as the resistance level, while the bottom of each wave marked by a horizontal line is known as support level. Demand and supply. Unlike support and resistance, demand and supply levels are marked in zone. Demand level in the market chart are level where buyers are waiting for that zone, are waiting to buy at that zone. Supply levels are levels in the market where sellers are waiting to sell from that zone. Okay, this is where we stop. Please like, subscribe, and hit the notification bell for more updates. And also, I'll leave the PDF in the description box so you get to download the PDF and read more. Try to understand it better. Thank you guys. Have a wonderful